For hundreds of thousands of years, the human brain was wired for a very specific job, keeping us alive in a physically dangerous environment. If a shadow moved or a branch snapped, your ancestors didn't calculate probabilities, they just ran. That immediate, intense reaction to physical threats kept our species alive, but applying that exact same survival instinct, avoiding danger and seeking immediate safety, to our personal finances is a guaranteed way to go broke. Behavioral researchers, like psychologist Daniel Kahneman, identified this glitch in our biological software. It's a cognitive bias known as loss aversion. This visual scale shows loss aversion in action. When measured in a lab, the psychological pain of losing $1,000 hits our brains about twice as hard as the pleasure we get from gaining that exact same amount. Because our internal emotional gauge for risk is biologically broken regarding money, our attempts to make financially safe choices are exactly what guarantee our financial ruin. When the stock market experiences standard volatility and prices drop, that ancient alarm bell rings in your head, screaming at you to flee the danger. Looking at this market line chart, you can see the result of that instinct. Investors panic and sell their assets right at the lowest dips to stop the pain. Then, driven by greed, they only buy back in when prices hit their highest peaks. Then there is the opposite reaction, paralysis. You hold on to a sinking, depreciating asset simply because hitting the sell button means admitting defeat and locking in a realized loss. We stare at that dashed line, our original purchase price, holding on to the irrational hope that the investment will magically bounce back so we can just break even. Whether you are frantically selling a perfectly good index fund or stubbornly holding a dying stock, the root cause is identical. You are letting the fear of a realized loss override objective mathematical strategy. The ultimate fear response is abandoning the market entirely to hoard cash. You eliminate perceived risk by leaving it in a bank account paying zero interest, or literally locking it in a safe. This chart tracks the purchasing power of static cash over 20 years. We operate in a fiat monetary system, meaning our currency is backed by the government rather than a physical commodity. Because central banks continuously expand the money supply, inflation acts as an invisible, relentless tax on any cash you leave sitting still. Over a few decades, that perfectly safe cash will reliably lose half of its purchasing power. The numbers in your bank account stay exactly the same, but they buy 50% less. By retreating to the absolute safest harbor available, the investor mathematically guarantees the permanent destruction of their own purchasing power. Sometimes the fear driving our financial decisions has nothing to do with losing money. It is a subconscious avoidance of wealth itself and the expectations that come with it. Financial psychologists refer to these barriers as money scripts. They are rigid, deeply ingrained beliefs, often learned in childhood, that restrict how we interact with money. People will actively sabotage their own businesses or investment opportunities to stay inside their financial comfort zone. Stepping out of that zone means facing new responsibilities, complex decisions, and the social judgment of their peers. This severe deprivation mindset was famously captured by Charles Dickens. His character, Ebenezer Scrooge, is a man so consumed by financial anxiety that he enforces a life of isolation and misery to protect himself from the world. Financial stagnation is frequently a psychological defense mechanism built to shield our ego from the unknown pressures of success. The modern economy does not reward hiding. The entire monetary system is explicitly designed to penalize static, risk-free savings. Because of that structural design, taking zero financial risk is mathematically the highest risk position a person can hold. To build wealth, we must consciously divorce our biological emotional responses from our financial mathematics. We must accept market volatility as a necessary functional feature of long-term growth, rather than a defect we need to flee. True financial security is built through consistent, diversified investing over decades. But to achieve it, we first have to conquer our own biological instinct to hide.